Welcome, everybody. Really glad to see you here. Welcome. I'm Leanna Petrone, and I'm the Executive Director of LatinoBuilt. We are having Latinos Built virtual training about learning what financials means and how to get ready for the end of year taxes. If you are one of those people who want to get your CCB continuing education credit, please give me a private message with your name, your company name, and your email address. And we'll make sure that we get those certificates out to you for staying for the duration of this presentation. A few things to keep efficient flow of the training. Please know that this presentation is being recorded. And it will be available on our YouTube channel in the next few days following the presentation. Please remain muted for the duration of the presentation. And use the chat feature. It's on the lower bottom menu of your page to be able to ask questions during the presentation. We'll definitely have a lot of opportunities to ask questions during the presentation as well, but just so that our presenter is not disrupted in the middle, please use the chat and we will make sure that we get back to it. Let me see here. Now it is my pleasure to introduce Maria Rivas from Doty Purdy Wilson.
Hello, nice to have you guys here today. I am going to be sharing my screen, and I think my audio is having a little bit of difficulties. Please let me know if you guys need me to repeat something, and I'll gladly do so. Are you guys able to see my screen? Okay, perfect. So I'm going to dive right into financial statements, and there are three main financial statements that are used: balance sheet, income statement, and cash flow. Balance sheet gives the company's financial position at a point in time. So the one I created here is December 31st, 2019, and I also included 2018 so we can get a comparative view and see how the company did over a year. Let's start with current assets. So this is basically all the assets are stuff that have value to your company and that are usually converted to cash in less than a year. So we have like checking, all your savings. We have accounts receivable, which is money that is owed to you by your customers. In this case, this one has 1.596 million, and they have a couple of cash left in their checking and savings. Payroll advances, money that your employees owe you. Probably you gave them an advance. Usually I have customers that pay monthly, so they advance money to their employees every 2 weeks, just so they can get some money coming in throughout the month. Now, if you go down to property and equipment, this is also known as your fixed assets, and this is where you can tell what your company owns. This one has machinery and equipment, vehicles. Improvements can be leasehold improvements, or if you have a building and you're making repairs and stuff to it and it adds value. And we have accumulated depreciation, which I can get to once I get into the income statement. It's basically an amount of depreciation means like you're losing value. Your asset is losing value and you get to take that deduction. Under other assets, we start listing like note receivable. So this is money that you lended out to either a shareholder or yourself. In this case, there was some last year, but they repaid it during this year, or any other company. And this is all the sum of the current assets, fixed assets, and the receivables brings you to your total assets. So this is the total your company has on the balance sheet. Now we go down to liabilities and members' equity. Liabilities is money you owe, and this can be accounts payable. Accounts payable is usually what you owe to your suppliers. And we have payroll tax withholdings. And this is usually the payroll taxes that are deducted from your employees' pay stubs, and you have to submit to the federal and state. We also have credit cards and current portion of long-term debt. Usually banks like to see this because this is the debt you owe in a year. So what coming up, what is it that you're gonna have that you have to pay within a year? So this is important for when I get to the lender part. Long-term liabilities, anything that's a year or more. So we could have, in this case, this client purchased equipment, so he has this loan. They paid down 27,000 or 26. You could see the difference here. He also has a couple other loans with Selco Credit Union, Wells Fargo. Any business loans that are more than a year long would fall under here. And we back out the current portion because we already incorporated it up here, so we don't want to double count. Together, we come up with a member's capital, and this is basically all the income and money you put into it, less any losses or money you take out. We can see that for 2019, we had, and this is always what you start out from prior year. So this is the ending of 2018, and this will be your beginning for 2019. So every year it floats, keeps going. You have then that this client, we decided they took out 351,000 as a withdrawal or distribution, and they had net income of 1.1 million. And together, the current the liabilities and the members' equity have to equal your total assets. That's how you know that it's a balance sheet, because it balances. Now, you guys are free to ask questions on the chat throughout the presentation. Do you guys have any questions with this balance sheet before I move on to the income statement? So now moving on to the income statement, or this is all your revenues and expenses. We have this client that made 8.2 million in sales. And then we break out the cost of goods sold, which cost of goods sold is basically the expense that goes directly into your product or service. In this case, they have equipment rental, job travel costs, materials, payroll. And if we keep scrolling down, we can see payroll is broken out between cost of sales and other operating expenses. This could be like this could be like a roofer if it's a roofing company, because it's directly related, and this could be admin payroll. It's not directly related, but they are also part of your company and it's an expense. We have subcontractors, tools, workers' comp, and then so gross profit margin before your operating expenses is right here. This is your gross profit. So we could see that, yes, their income doubled from prior year, but so did their expenses. And so we're down to 2 million. And then we get into all the operating expenses, which you would see education. And this here is the depreciation. So for 2019, this client purchased a whole bunch of vehicles and new equipment, and we decided to depreciate it in full for tax purposes. It was beneficial that way they could get the tax write-off and not have a high tax liability, which is why we see a big difference between 2018 and 2019. 2018, they only took 87,000. 2019, they did about 372. We have rent, repairs, telephone, utilities, everything else you can think of goes here. We come down to our net operating income, which is your sales minus your COGS minus your operating expenses. And then we get into gain of sales. So if they sold any equipment, any interest income from loans or interest expense they have to pay on liabilities would go down here, making your total income 1.115. And this actually flows through to the balance sheet right here. That's how they are related for the balance sheet and income statement. Now moving on to the cash flow. This basically tells you what happened to cash. Where did it go? We start off with your net income and we add back depreciation, because this is not really something that you paid for. This is an expense you get to take. It could have costed you, let's say an equipment costed you $500,000, but we decided we only wanted to take 372. It's not really something that you paid the 372, but this is the expense we're taking. We add back the gain on the sale of assets that this client had. And then here is where it starts getting a little bit tricky. So this is actually interrelated with the balance sheet. It's what happened. In this case, I compared it from year to year. You could compare it month to month. But from 2018 to 2019, we could see accounts receivable went up 36,000. And so we start going down the net change column, which is what makes up your cash flows. Payroll advances went down. Your accounts payable, 476, that means you paid down about 476,000. We see that they have 34 and they started with 511. So this is net cash provided by operating activities. And then this here, it's everything you purchased or all the loans you made. So they purchased 44,800 in new equipment, and they purchased 239,000 of vehicles. They did improvements, but they also sold, which is why we have this gain. They sold an equipment, and since it was fully depreciated, they have a lien. You could have a gain or a loss, depends. And they were generous enough to lend out money to other companies or relatives, wherever they were. You got more in debt with credit cards, because this went up. You see it as a positive, so that means you got more debt. And they temporarily have a cash overdraft, which tends to happen at the last day, where your bank doesn't, when you reconcile your accounts, it doesn't, your bank, you could have written out like 30 checks on the last day. And yes, your books show that you paid that out, but the bank doesn't show that because the person probably won't catch it till the next day or 2 days later. So that's where you see a temporary cash overdraft or a difference. And then these are the payments you made for the year. You paid 17,000 to Toyota, 26 to this one, and 351 of distributions. That's money you decided to take out. Now all of this together, you started out with this net income. You backed out what you paid. You added back what was non-cash, and this is your ending cash balance. And then the way you know that this is correct, this has to match your total cash on your balance sheet. So 165 has to be made up between your checking and savings, which you can see down here. That's how you know. So that's how all of these three interrelate with each other. But this basically just deals with cash. So if you want to know what you spent your money on or where it went, this here will tell you. Are there any questions before I move on how to analyze these now? Okay. So you can analyze it as management, and you can also analyze it as a lender. I'll start out with lender. Lenders typically want to see how much money you're making, which in this case, this client is making a lot, but they also want to see how much you keep. You could be making 8 million, but they're keeping 1.1 million. They also want to see how much liability you have. So your total liabilities to your total income, how much you have to pay each month. I put together a few ratios here that are most commonly used. A big one that they use is debt income ratio, how much of your income goes to debt. In this case, I ran it, and 4% of this person's debt is going to income, and that's because they're generating 8 million and the total liabilities is only 296, which is good for this client. This client will not have trouble getting money. They also want to look at your profit margin, which is the measure of profitability, and that is based on how much money or profit you keep from all your sales. Now, looking at this, yes, they're making a lot of money, but look how much they're keeping. Only 14%. So that means for every dollar, they're only keeping 14 cents. So for, as a management, if this were my company's questions you want to ask yourself is like, okay, I am making this much and I'm only keeping this much. A, I'm either selling very low. B, my costs are way out of control, like here. Materials doubled, payroll doubled, You can see the difference here. Subcontractors went up quite a bit. So you start seeing like, okay, where am I spending money? And that's where I would start seeing how I can control costs to bring this down and be able to keep this ratio higher. So the higher the ratio, the better for this one. The lower the ratio on the debt, the better. That means you have more money to cover your debt. Lenders also would like to see accounts receivable turnover, which is how effective you are on collecting your debt. So in this case, this client had 1.596, but we also have to compare it with what they had at the end. They actually ended up having more. And when I did the ratio, however, it's sales divided by average AR. They're actually doing pretty good because again, their sales are pretty high, but they still have quite a bit that they're owed. And that we see that's common to see throughout every client. We normally run the books on accrual basis, but for tax, we do cash basis. So it's common to see the difference when we have to make an adjustment for AR and AP. So accrual basis means that you have to recognize the revenue and the expenses once they happen. So if you write an invoice to your customer on December 31st, you have to recognize that invoice if you're on an accrual basis. But if you're on cash basis, we don't have to recognize that invoice because you did not receive the money on December 31st. You received it the next year on January 15th. So that's the difference between accrual and cash. Another one, accounts payable turnover, how efficient you are with paying your suppliers and vendors. In this case, this company did really well since their AP is actually, they paid down quite a bit. And they're only at 34 compared to I only used materials. Other companies use total costs. In this case, I just used materials compared to the AP on the 34. And so we have it 7.47 times is how much they're paying their AP, which is really good for them. And the current ratio is also current assets divided by current liabilities. So let's say for some reason your company you needed to close your company or something happened. The lenders want to see how much of your current assets you have that they can convert easily to cash and be able to pay your current liabilities. And they have 13.61, which is really good. Now, each industry is different, and whoever you're comparing, if you want to compare your numbers to the industry average, you have to see what the numbers they're looking at. And each bank has different covenants too, and different ratings they want to see. I mean, as a manager, you may like to see a ratio, but probably lenders want to see a little bit different. So these ratios you can find anywhere, and there's a bunch more that you can run for your company to know how they're doing with financial position. But these are the most common ones. And for lending, the ratios along with your credit history is also very important. They want to see how you're doing to be able to lend your money. But you also want to be very careful when you're getting credit. You want to make sure you pay it off on time and not be paying, because you're going to end up paying a lot in interest expense if you get pretty crazy on your loans. So you also want to watch that. See what interest rate you're getting and which one's better. Okay. Now that, let's say we now have the balance sheet and the income statement, and you want some tax planning, like during this time, you want to get ready. So if you were my client, I will ask you to give me your balance sheet and your profit and loss up until November 30th. Let's pretend this is November 30th and you were at this much. I will then ask you, okay, so how much more income do you think you're gonna get? Are you thinking of buying, what are you planning for next year? Are you gonna hire more employees? Do you have a big project coming up? Are you gonna be purchasing a new property? And for that, I have a different tax plan. Okay. So I'm gonna use this example that I had with the client. So this client came to me on 11/30 last year, and this is how much money they were showing. I asked them how much more they were thinking they were going to get, and this is what they gave me. Remember, they are, for financial purposes, we're doing accrual basis, but for tax, we're doing cash, so we have to do an adjustment to get it to cash. And so altogether, this is their anticipated income, which is quite a bit if you want to work with it to not pay a lot of taxes. So I talked with the client and for tax planning, I'm like, okay, so you have the money to spend, and if they needed more equipment, they gave me a range of what they were thinking they were going to buy, and I decided, okay, let's work with this. If we have them buy 130,000 of additional equipment, vehicles, whatever they need, and if they're able to prepay expenses, and in this case, this client had a C corp, which we could probably transfer money over on a C corp. As an LLC, because they were an LLC, we see the total income here from this planner, the 1421. But they also paid themselves wages and they had other businesses. So altogether, this is how much with the income we were talking about. They get their self-employed tax deduction. So we have an adjusted gross income. And depending on their taxes, if they're itemized or they use standard deduction. Bottom line, this is taxable income. This is how much the IRS and state want to tax you on. Keep going down. Look how much they would owe federal taxes and how much they would owe state. Making this together 692,000 on their 1.5 income. And as I was adding more, as I was adding more planning for them, the income was going down. You can see it going down here. But still, as an LLC, when you put it all together, they're still paying quite a bit. It's going down, but it is still quite a bit. So another thing I suggested for this client was to switch to an S corp. And so the difference, let me go back a little bit. LLC could be a single member LLC or a partnership. You cannot pay yourself wages, so you are actually being taxed on the income, and the only thing you can do is take money out. Since nobody is deducting the Social Security and Medicare like most employers do with their employees, that's why the IRS taxes you on it when you do your tax return. So dependent, like this client was on the 37% tax bracket for Fed, and then depending on where you live, here in Oregon, we're at 9, but since this client had a high income, we were taxing in 10, and the self-employment is 15.3%. So when you add all of them together, it's over 50% that you're being taxed on your money as an LLC. Switching to an S corp eliminates the self-employment tax, but you become an employee of the company and you have to start paying yourself wages throughout the year. And that is where you pay your part of Social Security and Medicare. So we have the same income, but it's in different, now if it's an S corp, it's down here. We'll show it here. We still have the same total income. We still have the same itemized or standard, whichever they're taking. But now their federal taxes are a little bit less. It's a little bit more favorable. It still went way down. And yet they're paying themselves wages. And they're still able to keep their S corp income. And they're still able to withdraw money. But not as much as an LLC. You need to pay yourself more on payroll and take distribution out. You start getting into basis issues. But we were able to get them down to about 32, which is still a high tax bracket to be in, but what they were starting to be paid out reduced even more, so they could do some tax savings on there. So getting ready for tax planning. It is very important for you guys to have either you guys do bookkeeping or have someone help you with the bookkeeping. We just saw it this year with COVID. There's been a lot of grants going out there, the PPP loan, the EIDL loans. The first thing they ask you is for balance sheet and income statement, and it takes time to get it together and put it together. So if you don't have it ready, you can miss out on the deadline. And having this every day, every month, helps you as a manager and as an owner analyze how your company is doing. What's the overall health? So I would, getting ready for tax season is having your balance sheet, income statement, your financials ready, knowing what your upcoming plans are for next year, how much more income or expenses you're expecting to get, and then get together with CPA or with your tax preparer and see what you can do so you know at least how much you're going to owe next year or how to bring that tax liability down. Are there any questions?
Going back to the ratios page, I had a little bit of a question. I wasn't sure if you knew this information, but for construction businesses, do you know what the ideal ratios would be for lending? For these construction businesses to keep in their head, because everybody's always at some point looking for lending. It doesn't really matter where they are in their business, so it would be nice to know a good range for lending for them to keep that in their mind.
So I have construction companies that banks require them to have what is called reviewed financials. And that means it's a little bit more of us going in and digging and actually tying out balances and asking questions. And they provide us with loan covenants of where they want to see each client. So I can actually provide you guys with that so they can at least compare themselves to what the banks are looking for. Usually the debt to income, if you were applying for a mortgage, they would want to see this at 43%. If your debt to income ratio was higher than 42%, they wouldn't even turn on the pay because you're too risky. But it also depends, because you could have clients that don't have good credit, but because they have high sales and they're paying off their debt on time, the lenders will lend the money. But I can forward you guys that spreadsheet that we use to see how our clients are doing. And if
Yeah,
they're getting the loan coming.
yeah, that would be helpful.
I know I went probably a little too fast on my presentation. Is there anything else that you guys have questions on, or that even if it's a tax question or anything?
So what should we be preparing for taxes, since it's the last month of the year? What should we be preparing in December?
Since it's the last month of the year, you actually have a little bit of time, so you guys need to hurry. If you want to have some tax planning done, knowing where your numbers are at is very, like I mentioned, is very ideal, because that's how you will be able to know exactly how much to spend or how much money you have in the bank to be able to, if you need to take a bonus payroll, or if you need to go from an LLC to an S corp. And there's a time frame when you want to do that. Not everybody should be S corps. It's dependent on your income and on your goals and what the business is looking at. Another thing is knowing, I know it's a little bit hard sometimes knowing, like for this, let's say this client, they're not sure how much they're going to be able to collect by the end of the month. They could get a check in 2 weeks, they could get all of it tomorrow, or they can get all of it in January. But having at least an idea of knowing. And it's also important to keep track of this accounts receivable so you know how you're doing in collecting your AR. If you need to provide maybe a 10% discount if it's paid within 20 days or that 30. It's also a good idea to look at that to see how your collections are doing. And analyzing and looking at this too, I could also look at payroll advances and I would ask, why are my payroll advances so high for this company? If employees owe you 28,000, are they really going to be able to pay you back? Are they making monthly payments? Or why is it so high? Yeah.
Maria, would you tell us a little bit about your experience and your expertise and why we have you here today is because of that ultimately. And then I can go into telling them some of the perks of LatinoBuilt members, what they have.
Yeah, so I have been in accounting for 7 years now. I have been a CPA going on to 3 with my license. I am focusing on trying to help the Latino community. There's not a lot of CPAs that speak Spanish, and it's very important for people to understand when, especially when you see all these numbers, like what does this mean? What does current assets mean? What if I have this much in? What if I have this much in checking? It's important for them to know like there's stuff to do. There's planning strategies that you can take, so you don't have to pay all the taxes. Um, I have an office in Salem and in Portland. I can drive up to Portland too. And yeah, I joined,
Perfect.
I joined LatinoBuilt for the same reason because I saw it's for helping out the Latino population. And that's why I reached out and see if how I could help you guys.
Sure. And we certainly appreciate you. And we're still open for questions. But I just wanted to let you guys know that I understand, you know, we at LatinoBuilt understand. I mean, I think almost everybody, tax season is stressful, especially for businesses. I feel like it's another language personally. Um, so we have at LatinoBuilt for members, we do have some funds that we can allocate towards assisting you with some of the costs for whether it's your tax preparing or what have you through Maria. We don't have a lot of funds, but we have some. So if you are in need of a little help there, reach out to us, reach out to Dulce, reach out to me, and let us know, because it will be at a first come, first serve basis for it, but we're here to help you. You know, that's our entire goal and mission of LatinoBuilt, as well as to be able to serve you for what you all need. And so there's another one. There's a question from Gladys says, Maria, are you taking new clients? I think my dad would really benefit from you.
Yes, we're taking the clients. And another thing, our firm actually offers free consulting. That's the first time we meet you guys. That way we know you can get to know us and we get to know you guys and see if we're a good fit. But I encourage everybody to take advantage of that, and that way, yeah, at least do a consult or come see us and see how we can help you. But yes, we're actually taking new clients.
Any more questions for Maria? Okay, well then on that, we will finish up our presentation. Give me a second while I share my screen. I don't know, it takes me forever, no matter how much practice I've got. So once again, if you guys want your 1 hour or one CCB continuing education credit, make sure you send me an email or something with your info to make sure that we get you your certificate. There is an excellent way to connect with us. We want to connect with you always. Email, our website, our Facebook, our LinkedIn, our e-newsletter, and then of course our YouTube channel that houses all of these great video recordings as well. And thank you so much for attending. Thank you, everyone.